I'm Martin King. I'm property analyst at Edison Investment Research, and I'm joined by Richard Shepherd-Cross, who's fund manager for Custodian Property Income REIT. Welcome back, Richard.
Thanks very much for having me.
You're welcome. Richard, Custodian has just published its latest set of annual results, but rather than go down in the weeds of too many numbers, I'd like to step back a bit. It was the second strong year of performance in a row. If you take the change in the NAV and the dividends you've been paying, it's a return of more than 20% over that 2-year period. Could you maybe talk to what's been happening consistently over that period?
I think there is a very simple answer to that, and it's rental growth. We have seen rental growth in our portfolio for a number of years now. This year, for the first year in a few, we've seen rental growth in all sectors. Yes, also in offices and in high street retail, and that's a turnaround from perhaps last year when office rents were still declining and retail rents were reaching the bottom. This year, we've seen positive rental growth progression in all sectors, still being led by industrial and logistics, 4.1% rental growth in that sector in our portfolio, being chased hard by retail warehousing, out of town retail parks, where we've seen 2.6% rental growth. And none of this should be a surprise. Real estate is an income investment. The values are based on capitalizing an income stream. And when that income stream starts to rise, all things being equal, then values rise on the back of it. And if you do, for a moment, get into the weeds and consider that straight line relationship between underlying rental growth and net asset value performance, rent roll grew by 3.4% in the year. NAV per share growth 3.7%. So you can see that very straight line relationship. And I think it's worth saying that we have all lived through, in the last 15 to 20 years, periods when we have seen extraordinary growth in real estate values. And that growth has been driven by yield compression. And real estate yields are inextricably linked to the gilt yield. And I don't think we're going to see those long-term gilt yields falling. And if we don't see that, we won't see that yield compression. But that doesn't mean we won't see growth, because we will see growth based on that underlying rent roll growing. So that is the simplest answer. I know I've made a long answer out of a simple response, but just worth understanding the drivers.
Okay, great. Look, we'll come back to how that might be changing. The world is changing day by day. But first, the other thing that stood out in the last year is the progress you've made with your growth strategy. Could you maybe talk about that and also that progress?
Yeah, well, I think we've all seen over the last few years a lot of consolidation in public markets, but the opportunity that consolidation creates is not exclusively the preserve of public markets. So we've been doing the same in private markets. We've acquired 3 private property companies, sort of 64 million added to the portfolio. And there, of course, with every transaction, there are 2 sides to the equation: what's in it for us and what's in it for the private property company that is sold to us. From our perspective, we think this is a great time to buy real estate. We feel like we're at the bottom of the cycle, and the comments I made about high street rents and office rents having turned the corner and moved into a growth phase really supports that view. If we look at our valuations, they've been growing since September 2024. So we've had 18 years of sometimes quite marginal but steady positive growth. This is a great time to buy real estate. And we can secure portfolios through corporate acquisition in a very efficient way. We don't have to pay stamp duty land tax because we're buying the share capital of the company. We perhaps don't have to wring out every last penny in the price we pay for these assets, because from the vendor's perspective, there are enormous tax advantages and broader advantages that I'm happy to go into that make the sale of their property company in an all-share transaction a compelling exit. We think there are tens of dozens of opportunities out there that would fit the bill, and we feel unusually well placed amongst our peer group to take advantage of those opportunities. Why? Because our portfolio is built up of smaller, regional, diverse assets, just the sort of assets that are typically held in private property companies. They would be less well suited to some of our larger peers who perhaps have a more sort of institutional lot size portfolio. So I'd say watch this space. I think you should expect to see more consolidation of private property companies in the year ahead. I think you should see further rental growth, and I hope that leads both to valuation growth and continued recovery in our share price.
Richard, it's good to hear you say this is a great time to buy real estate because, as I said before, things have changed a lot over the last 6 months. If we picked up the newspaper at the start of the year and read today's headlines, we'd have had quite a shock. So do you want to just expand on that bullish view a bit more?
Yeah, well, I think the property market has been straining at the leash to recover for 2 years now. Last year, we were held back by, firstly, Liberation Day, and then the budget that weighed heavily on people's optimistic outlook. But from November, following the budget, from November last year until the end of February, in common with most listed stocks, we saw our share price really move on quite meaningfully. It grew 12% in that period. In the month of March, the first month of the war in Iran, we lost all of that. That full 12% recovery was reversed. Since the end of the first month, we've seen all of that 12% back again. Now, is that because people are starting to learn to live with the chaos and look through all the geopolitical and let's face it, much closer to home, political noise, and identify the positivity that is coming through from rental growth that is driving performance, which is where we started this conversation? What's going to happen next? Because I don't know the answer to that. Someone much wiser than me said recently, if you are waiting for the chaos to end before you invest, you'll have a long wait. And actually, when you think back through the trials and tribulations of politics, geopolitics, and the economy over the last 10 years, there has rarely been a nice steady time to invest. But real estate is a great asset to own in inflationary times. Real assets that have the ability to grow underlying rents, protect the value of that pound invested over time. And I think we have been living through and will continue to live through inflationary times as a result of the challenges in the wider world and our own economy. And in that inflationary time, I think that many investors will look to real estate as that good hedge against inflation.
Okay, and you started, Richard, you said that this is all about rent growth, income and dividends. What should we be expecting from Custodian?
If you look back at our past performance, which I know is no guarantee of future performance, but I think what it demonstrates is the attitude of us as a manager and our board, where there has been capacity to increase dividends on a sustainable basis. We have always done that. And if we look through the last 4 years, we've had earnings per share growth for the last 4 years consecutively, and our dividends have gone from 5.5 pence to 5.8 pence to 6 pence, and we've committed to a minimum of 6 pence dividend for the year ahead. Of course, as we look forward, despite all the positivity around rents growing, we also have to acknowledge that there is a very realistic chance that the cost of debt is going to increase over time. Our current weighted average cost of debt is 4.1%. Variable rate debt today around about 5.6%. And we have to balance the competing pressures of increasing cost of debt against growing earnings before we can say with conviction that we can grow dividends on a sustainable basis. But as I said before, where we've had capacity to do that in the past, the board have taken that decision.
So rather than stick your neck out now, let's maintain an attractive, sustainable dividend. And if there's more to go for, great.
Well said.
Thank you very much for joining us.
Thank you.